Bradken. Look, it certainly didn't outperform in terms of their headline number by any stretch of the imagination, but once again, Tim, it's all about the outlook.
That's right. I think it was a bit of a mixed result actually from Bradken. The shares have certainly reacted very well, up 9%, and it certainly sparked some optimism in the mining services space on the market. If you look across the market, Ausdrill, NRW Holdings, Boart, Longyear, all up over 5% in trade today. And the first half profit headline figure, as you did mention, was higher by 9%. But I think the outlook statement from the company is certainly what's helping buoy the share price reaction in the market today. And I think the moves within the mining services space over the last year have been quite interesting. Obviously very sensitive to the mining sector, the capital expenditure and commodity prices within the mining sector. And through 2012, we saw a lot of earnings downgrades, some capital raisings, etc., from some of these mining services companies, and the share prices really did suffer significantly. But if we have a look at recent performance, some of these companies have actually rebounded very strongly over the past couple of months. If we look at Bradken, up 45%, Monadelphous 35%, NRW up 55% from the lows we saw late last year. So I think what the question now for the market is this just a case of sort of bargain hunting off the lows, that the fact that these companies were oversold? Or given the fact that the market generally is forward-looking, does this mean that the market's looking towards a bottom in the earnings cycle and that this kind of cyclical industries are going to start moving higher through maybe second half of 2013, as Bradken commented on today? So we've got to remember that these beaten down cyclical spaces are the ones that rebound the hardest after being sold off in these kind of market conditions. And we're actually seeing it across some of the other sectors in the market at the moment. If we look within the retail space, Harvey Norman in February alone has bounced up 20%. And if we look in the building materials sector, you've seen some of those players bounce back very strongly over the past 6 months, even though we haven't really seen any concrete evidence that the housing market or construction's really improved here in Australia. So the market, I think, a bit forward-looking in its performance recently.
Waiting and expecting the big bounce back in some of those beaten down stocks and sectors. What about gold? I mean, where does that fit into the equation? I mean, so many bulls in terms of the outlook for the gold price, and yet gold stocks, again, we're seeing it today, massive underperformers.
Huge underperformers on the market today. Gold price slipped over 1% overnight. And if you look across the ASX 200 today, if you take out of the equation Tabcorp, who's down around 4% because it went ex-dividend, the bottom 12 performers on the market today are all gold mid-cap producers and explorers. So a very bad day for gold producers on the market. And over the past 3 months, when we've seen the broader Australian market rally, gold producers have also underperformed significantly. The gold price has come off around 8 or 9% over the past few months, and we're seeing some of the mid-cap miners particularly underperform significantly. Silver Lake Resources, Perseus Mining off around 20% over the past quarter. So I think what this is indicating is possibly the market not so confident in terms of the gold price moving forward, possibly. I mean, if you look at what some of the major drivers of the gold price are inversely correlated towards real interest rates in the US, as well as the US dollar. Now, if the US and global economy starts taking off, you would expect both of these to start rising, which would be a negative for gold prices. And of course, we have come across some significant resistance within the gold space at around that 1800 level. It's made about 4 attempts to break through 1800, which it hasn't managed to do significantly over the past 18 months. But on the flip side, if we have a look at a 10-year chart of the gold price, you can see here, back in 2008, 2009, over that same time period of 18 months, it tried 4 times to break through the $1,000 level, which it failed 4 times. Eventually it did, and as we know, the gold price has almost doubled since then. So I think the range that it's trading in at the moment, 1550 to 1800, very important to see which side of that range it's going to break out of, because it's going to be an indicator of where prices could be heading from there.
And look, just finally, I wanted to get your thoughts on the broader market at the moment. I think we hit a high intraday earlier on, about 49.81, 5,000 looking an awful lot closer for that index level. We've seen it pull back a fair bit, flat at the moment. Look, what do you make of the pullback we've seen, and I suppose the general focus on 5,000?
Well, there is a lot of talk in the market, 5,000. We saw the All Ordinaries just reach 5,000 today, but I think maybe of an indicator of how it might be a little bit difficult to break through the 5,000 level after it did touch there. It's pared back those gains to trade flat today, despite some of the Asian markets coming online with strong performances, such as the Nikkei 225. But once again, it's the materials sector which is weighing on the market. We're seeing a couple of the the big four banks are in negative territory at the moment. And I think the key for 5,000 within the ASX 200 index will be some of those large corporate companies that have really underperformed recently, and a lot of those are within the resources, energy and mining space. So if we have a look at some of these companies, they're actually at some key resistance levels as well. BHP, Woodside Petroleum, Fortescue Metals, those kinds of companies are all at sort of 2-year resistance levels, in particular Fortescue around that $5 mark, BHP around that $38 mark, and Woodside around $36. Now, if they can actually break through those levels, they could provide some backbone to a continuation in this rally. But I think the market at the moment, the ASX 200, it's a little bit frustrating if you look back over the past few years, because at this kind of level, we've come to this 5,000 level a few times since 2010, and failed to break through. But if we have a look at a chart of a 5-year of the Australian market versus the S&P 500, you can see the S&P 500 really hasn't had any problems breaking through resistance levels and going back up to those highs not seen since 2008. So I think another resistance level which is adding to pressure in the market at the moment is that 50% Fibonacci retracement, which is what we're at right at the moment, which is the retracement from the highs seen back after before the GFC.